It's been pretty much all good news if you've had money invested in the past year or so. And even what we called at the time the Liberation Day crash in April is now a well-healed, healed with an a well-healed pimple on the graph of investment returns over the last year or so. One of my younger advisors joined me 3 years ago this month in fact, and most of the meetings she came to, certainly in the first year or so with me, gave bad, or at the very least not such good news about the performance of clients' investments to them. Everything had recovered after the COVID crash, then Putin invaded Ukraine, then Liz Truss briefly invaded Downing Street, and things looked dire. Particularly for those who'd put money in, as many had, a couple of years before. I say many had because lockdown did have an effect. People had built up savings and decided, yes, they needed to sort out their money and their financial planning. And most financial advisors saw a mini boom towards the end of 2021 with many investing, often for the first time, in that wave of optimism and pent-up spending that pushed stock markets up before Ukraine happened. Now, things turned around again in 2023, and we've been giving clients pretty good news about their investments for quite a few months now, which should be great. Yet, the question we've been asked a couple of times in the past week or so is whether everything's going too well. Should we be looking to cash in while the going's good? Are they never happy? Or just being sensible? Well, cashing in usually means moving to somewhere safer, selling and putting it into a bank or building society account, perhaps moving to more cautious funds with a bigger proportion in things like government bonds or corporate bonds, loans to companies rather than shares in them, or being radical and buying gold or property. Now, gold is an interesting one. You may remember I quoted a social media comment I'd had on another recent video, advising me, or all of us, I guess, to buy gold, leave the city, become self-sufficient before it all kicks off. I've heard many times it's all going to kick off in COVID, when the Queen died, when, and I'm sort of relaxed about that. But what about buying gold? Always a good investment. Well, sometimes it is, but it's only been the best performing of all the asset classes, that's different varieties of shares and cash and bonds and so on, in 4 or 5 of the past 50 years. If we do go back to Armageddon-style bartering, it may be useful. Although I'd say vegetables will probably be better, Monty Don will be king, but otherwise it is in reality pretty volatile, not so easy to buy and sell as you might think. So what about sticking it in the bank when things are up and putting it back in when things are down? Well, here's the thing. You never know when markets are at the top or the bottom. And all of those paid fortunes in the city to second guess it, well, only half ever get it right at any given time. Trying to time the market is, if not a mug's game, certainly just as much, if not more of a gamble than staying put. Reducing risk? Well, for most of our clients, the investments they have are in a mix of shares and fixed interest type investments. So the balance, that potential reduction in risk is really already built in. Moving to cash? Well, we certainly make sure and are sure to check with you when we review things that you have a good cash reserve in the bank and or in our favourite go-to premium bonds. That should mean that you can weather the ups and downs and shouldn't need to dip in when your investments go down, because they will go down. But if you hang on, and that's the key, if you hang on, they will go up more than they go down, and investing in a broad spread of stocks and shares really is the only proven way to beat inflation. Yes, it's true, and here's something else which is much discussed at the moment. It's true that those Apple and Nvidia and other big tech and AI shares can't go up forever. The companies are worth crazy amounts. Surely they'll crash down to earth at some time. Well, maybe. But do you really want to miss out on what the investment chaps would call the upside if you haven't got a crystal ball? Keeping your toes in lots of pies, or words to that effect, is, I would say, and always have said, the best bet. If you're in it for more than a couple of years and have that cash buffer we always recommend, you'll be fine, I'd say. And hopefully I've said enough times in this that the value of your investments can fall as well as rise, and you may not get back what you originally invested. With the proviso, you may not get back what you originally invested if you cash in when it's down and don't hold on until it's up. It will be all right in the end. And if it's not all right, you've guessed it, it's not the end yet.